Hey there, ever opened Snapchat, sent a few goofy filters to friends, and thought, how does this app even make money? Well, you're not alone. But the bigger question is, how is Snapchat making billions and still losing money? Seriously, this company pulls in over $5 billion a year and somehow keeps burning cash like it's bonfire night. Let's break down why Snapchat is bleeding money and what it means for investors in the future of the company. First off, Snapchat is not some irrelevant app fading into Gen Z nostalgia. As of Q1 2025, it has over 460 million daily active users. That's more than Twitter, more than Pinterest, and it's growing. In 2024, the platform's revenue hit $5.36 billion, which is a 16% jump from the year before. Most of that came from digital advertising, Snapchat's bread and butter. Direct response ads, the ones that pop up after you've looked at something once online, made up around 75% of their total ad revenue. On top of that, their Snapchat Plus subscription, launched in mid-2022, is doing fairly well with 15 million subscribers. That alone pulled in $152 million in just one quarter. So if the money's rolling in, why the panic? Let's talk about expenses. Snap's operating costs in 2024 were a staggering $6.15 billion. That's more than what they made. Let that sink in. They made $5.36 billion, but spent $6.15 billion. And this isn't some one-off mistake. It's been a trend for years. A big chunk of that goes into research and development. Snapchat is betting big on augmented reality and artificial intelligence. Over 200 million Spotlight videos were created using AR lenses in 2024. The company also has over 400,000 AR creators who've built more than 4 million lenses. And while all that innovation is impressive, it's expensive. Hiring engineers, designers, researchers, it all adds up. They've also been expanding their AR capabilities to integrate better with shopping features and product try-ons, hoping to boost e-commerce traction. But this segment is still far from profitability and continues to be a cash sink. Then there's marketing. Snapchat is fighting a constant battle to stay relevant and grow its user base. TikTok is breathing down its neck, Instagram Reels is out for blood, and YouTube Shorts is eating everyone's lunch. To compete, Snap has to spend heavily on marketing. It's not just online ads, we're talking influencer partnerships, sponsorships, events, and creator funds. They're spending a lot of money to keep creators on the platform, but it's turning out to be more expensive than they expected. And don't forget the general administrative costs, including a mountain of stock-based compensation, which keeps ballooning every year. In 2024 alone, stock-based compensation added nearly $800 million to their expense sheet. So how bad is it? In 2024, Snap reported a net loss of $698 million. That's better than 2023, where the loss was $1.32 billion. So yes, they're losing less, but losing less is still losing. Investors aren't thrilled, and the stock reflects that. In May 2025, Snap is trading around $9.10, a far cry from the $80 it touched in 2021. That drop isn't just due to broader tech sell-offs. It's because profitability keeps slipping away like a mirage. Now, let's zoom out. If you're running a company that had strong user engagement, growing revenue, and a subscription model picking up steam, why would it still be bleeding money? It all boils down to ambition versus efficiency. Snap wants to be seen not just as a social media company, but as a tech powerhouse in AR, AI, and visual computing. That kind of positioning demands massive upfront investment. But unlike Meta, which can afford to burn billions on the metaverse because of Facebook and Instagram's cash cows, Snap doesn't have that luxury. Every dollar spent is a big bet. They don't have diversified income streams the way Meta or Alphabet do. It's a high-stakes game of focus. And here's where things get even more complicated. In April 2025, Snap's executive team made headlines by refusing to give financial guidance for Q2. That's rare. Public companies usually at least pretend they know where they're headed, but Snap pulled the plug, citing economic uncertainty, slowing ad budgets, and potential fallout from global tariff tensions. Translation: we're flying blind and we don't want to scare shareholders with a guess. Not very confidence-inspiring. At the same time, Snap is trying to expand globally. That's not cheap either. You want to enter markets like India, Brazil, or Southeast Asia? You need language support, local teams, partnerships, regulatory navigation, content moderation, and payment system integration, all of which costs more money. Competition in these markets is fierce, with TikTok dominating short form and Meta owning the social space. Snapchat needs a unique value prop to avoid becoming an afterthought in these regions. And let's talk about Apple. Remember when Apple introduced app tracking transparency in iOS 14.5? That small update shredded Snap's ad targeting capabilities. Advertisers couldn't measure performance as easily. ROI got murky, and when brands can't measure returns, they pull back their budgets. Snap's CFO acknowledged this impact in every single earnings call since 2021. Although Snap has tried to build out its own tools and first-party data systems, they're still recovering from that hit. Now, to give credit where it's due, Snap has improved its free cash flow. In 2024, it hit $219 million, a sharp rise from $35 million in 2023. That's a good sign. It means they're managing day-to-day cash better. But free cash flow isn't net income. It's a breathing room, not profitability. And don't forget, the company has around $3.7 billion in cash and marketable securities. That's a decent war chest. But with the way expenses are tracking, if they don't curb spending or drive significant revenue boosts, they'll burn through it sooner than later. Analysts have estimated they could exhaust this buffer within the next 18 to 24 months if growth doesn't accelerate or losses don't narrow. So where do they go from here? The most obvious path is monetization. Snap needs to make more money per user. Right now, their ARPU, average revenue per user, is around $3.29 globally. That's better than some platforms, but nowhere near Meta, which sits around $10 globally and nearly $60 in the US and Canada. Snap has to either boost this number or shrink its spending, or ideally, both. They're also experimenting with new monetization strategies like AR shopping, integrating e-commerce into lenses, and AI-powered discovery feeds. But these are still in early stages and not guaranteed revenue drivers. Investors want results now, not in 5 years. Snap has even hinted at enterprise AR tools for retailers and agencies, which could open new B2B revenue streams, but again, uncertain timelines and high R&D costs. The good news, Snapchat's engagement metrics are strong. Time spent on Spotlight is up. Content creation is growing. Their young demographic, especially ages 13 to 24, is highly active. Brands love that. But whether that engagement turns into profit is the question. Ultimately, Snapchat is burning money because it's trying to do everything at once. Grow fast, innovate in AR, expand globally, and take on giants like Meta and TikTok, without a strong enough cash machine to support it all. It's like trying to win a Formula 1 race with a sports car engine. It might look fast for a while, but you'll burn out if you don't refuel smartly. For investors, the takeaway is simple. Snap is a company with potential, but not without risk. It's not just about user growth anymore. It's about proving it can turn those users into sustainable profits. Until then, the bonfire of cash will keep blazing. And now, you know why Snapchat is burning all their money. It's a mix of big dreams, fierce competition, and the brutal cost of trying to be the next big thing in tech. Whether they pull it off or burn out entirely, that's the billion-dollar question. Stick around because the next few quarters are going to be very interesting.